So the concept here is that the IRS is looking at an accrual method taxpayer, and we should note, obviously, that the lower tier operating limited partnership is not technically a taxpayer, but they're a tax filer, and their partners will then end up being responsible for that. But in their reporting here, there's some taxable income, and the IRS is looking at that and saying, hey, we would really like to be able to tax that at some point. And so got the smile on their face. However, there is a related party loan that the developer, who's a cash method taxpayer, has extended, let's assume that they're related parties, hence the related party loan, to the lower tier limited operating partnership. And so of that taxable income that we're expecting, there's interest expense on that loan that has been accrued. For books, we debit interest expense related party loan for $9,426. Now the IRS is thinking, well, that would reduce my taxable income by that and any other expenses, obviously. But they look and say, at least they're going to be paying the developer. You got interest expense, you got to pay the person you owe the interest to. So that would be taxable income on the other side. Then that happy face returns and they say, all right, well, at least I'm getting it over here. However, let's assume the interest is accrued. It's incurred but not paid. So what we have there is an interest payable related party loan on the books of the accrual method taxpayer. And then the developer says, sorry, we haven't received any income, and since we're a cash method taxpayer, we don't owe anything. We only owe it when we receive it. So this does not apply to us. And then you've got the other side who's also trying to claim the deduction while the cash basis developer is not claiming the income. The IRS is left in the middle, unable to tax that amount. So hence their ire is kindled and directed toward the offending party here and the Internal Revenue Code. This used to be commonly an M1 adjustment, but now it's more commonly an M3 adjustment for tax. They would require a suspension of that amount, saying if you've got, so three things need to be present. You've got a related party transaction, and there is the payee is a cash method taxpayer, and the item in question has not been paid. It remains payable. Now, if this were an arm's length transaction, the IRS essentially would, the technical term for this, I guess, would be they would eat it, but the Internal Revenue Code suggests that related parties are concerned that they could conspire together and say, all right, how do we avoid you recognizing income while I'm still able to deduct things? And so hence, we have a 267 asset suspended interest and 267 suspended interest expense as well. So that essentially, even though your books would recognize it because your books generally are not beholden to the IRS, they're beholden to other parties who want to look at your audits. As far as tax land is concerned, to eliminate that interest expense or the $9,426, you have a contra account, so a suspended amount. And that would be a credit, and then that's your difference. So what we're showing is of all the interest to all the loans that we have, because of this 267 related party issue, 9,426 of it should not be counted. And then the IRS, of course, is happy. They're able to count it. So you have a higher amount of interest expense per book, unlike depreciation.